On to learning objective 2, talking about repurchasing shares. This is a good one. Why in the world do we want to repurchase shares, and then how do we tackle that afterwards? Well, that's a really good question. A corporation might want to repurchase its shares or buy them back for a couple of different reasons. They may have issued all their authorized shares, and they might want to recover some of those shares so they can pay some out in bonuses to officers, employees, that sort of things. I'd say that's not very often what happens. It's the second part here, what happens. The share market price, they want to increase the share market price. So what they do, again, this is economics, just decrease the supply of shares and you'll increase the demand, which should increase the price. So that's the most often what we see. Sometimes we'll see it also to avoid a takeover. So in other words, buy shares back from some people who might otherwise sell. And then often for banks, we'll see that we need to have certain percentage of share ownership, or we're going to get into something called earnings per share. And so sometimes we need to have only a certain number of shares issued. And so we've got to buy some back in order to meet what the bank covenants might say. Now, the Canada Business Corporations Act says that when you repurchase shares, you should just cancel them. They're done. They're authorized, but they're not going to be issued again. You usually only buy shares back if you got enough cash to do that. It's unusual where you would buy them back and put yourself into a hole. A company would repurchase shares both to decrease the corporation's assets and its shareholders' equity. So in other words, they would spend cash to sideline some of their investors. Some provinces require the shares to be canceled, while others will say, well, you can just put them into treasury and you can sell them like you would sell any other shares. So it works both ways in different provinces. But yeah, either they're canceled or they can be sold again. It just depends on the province. Here's an example of a company, Dawson Resources. This is their shareholders' equity section at February the 28th of 2020. You can see how they've got common shares issued here, 9,000 shares issued. Remember, authorized is just the maximum amount they can issue. So they've issued 9,000, and when they initially did that, they got $180,000 for that share issuance. Plus they have $24,000 in retained earnings. So this makes up the entire shareholders' equity section. So the average issue price, and this is important going forward, understanding the average issue price is the $180,000 divided by it should be 9,000 shares, will give you $20 per share. So if it repurchases 1,000 shares, then again it's $20 a share. We know that the average purchase price is. So if they purchased it back for $20 a share, there's no premium or discount. There's nothing. We're just buying them back for what we issued them for. So we would debit the common shares for $20,000 and credit cash. So that reduces cash and that reduces the amount of common shares. So here's what the shareholders' equity section looks like before and after the repurchase. So before, here it is again, 100,000 shares with 90,000 shares, with 9,000 shares, issued. And after the repurchase, well, we only have 8,000 shares issued, and you can see how the common share account has fallen by $20,000 from before to after. Retained earnings has stayed the same. The only thing that changed was the common shares. And then a note. Yeah, usually there's a note in the financial statement saying we have repurchased some shares, and here it is down here. Now, if the average issue price is $20, so the same situation we had before, and they repurchase these, they purchase 1,000 shares, but they they purchase it cheaper. If the company buys them back at $15 a share, so below the issue price, then the entry is a little bit different, because we've got to get rid of the shares that were issued and the price that they were issued. So we eliminate $20,000 worth of cost or issue price on common shares. The cash we pay out is only $15,000. So that's a credit to cash of $15,000. But then in the contributed surplus line, now this is a different account, but it shows up in the shareholders' equity section. But contributed surplus share purchase is the difference. So in other words, we sort of have a win to the tune of $5,000. So we record that in that account, and it'll be in the shareholders' equity section. Again, yes, it's just part of shareholders' equity along with share capital. So looking at the shareholders' equity section of the balance sheet, you can see before it was $180,000 in common shares. That'll go down by, in this case, it goes down by $40,000 because we bought back 2,000 shares at $20 a share. So that would be a reduction there of 40,000. So 180 to 140. And then the contributed surplus, well, that was the 5,000 shares that, or $5,000 that we had in sort of a win, if you want to call it that. And so it gets included with contributed capital. So total contributed capital 145,000, shareholders equity 169. So it's changed just slightly only because we had a win on the buyback of some of those shares. So what happens now if you have an average purchase price of $20, but you buy them back at an increased value? So we'll see what happens here. So the purchase price is more than the issue price. So in this case, we're buying back at $30 a share. And what's going to happen, we know the average issue price is $20 a share. So again, we have the same sort of parts of the entry. The common shares, we have to get rid of the common shares. And again, we had 1,000 of them at $20 a share. So we get rid of that. We know the cash out of our pocket is $30 a share times 1,000 shares, or $30,000. And so we have a $10,000 difference in there. Well, the first thing we do is we reduce any contributed surplus for that share repurchase. Remember, we had 5,000 before. Well, we would reduce it by another $5,000 just to eliminate that account. We use up any contributed surplus firstly, and then second, we would charge retained earnings or charge against retained earnings any other amount that we didn't that was necessary in this entry. So looks a little different, but suffice it to say, we're using some of our profits to buy back our now inflated price of our shares. So I guess the thing is here to remember that the existing contributed surplus is the first thing that we're going to use up whenever we buy shares at a higher price than we issued them at. And then if there's nothing left over after that, then we still have, but we still have to make that journal entry balance. Then we charge that reduction to retained earnings. So again, we start with 180,000 in shares. We buy we get rid of 1,000 common shares at $20. So we go from 180 to 160. And then we need to make sure that afterwards we take and reduce in this case, it was $5,000 worth of contributed capital. Well, that's gone. And then we would hit retained earnings for whatever was left over. So here's just a bit of a summary of how this would work. Common shares, again, if you're repurchasing at the average issue price, then it's just the number of shares you're repurchasing times the average issue price. You debit there, and you credit cash for the number of repurchased times the price paid. So that's, again, the price paid is the same as the average issue price. If you repurchase below the average issue price, these numbers we know what these numbers are. We get them from before. And the difference is just allocated to a contributed surplus account for share repurchase. Okay, so moving ahead here then. Oh, a little too far. Okay, we'll back this up. Give me a second. So then if we move a little ahead here and we just look at repurchase shares, just know that if we repurchase some shares and then we sell them, well, it's that subsequent sale is no different than the original sale of authorized shares. And the repurchase or sale of shares doesn't impact net income, really just impacts the shareholders' equity section. One of the requirements is that all of these transactions need to be disclosed in the notes to the financial statement. And insider trading not allowed, you bet. If someone knows that a share repurchase is going to happen and then finds out subsequently that there was all sorts of things happening in the background where the company was going to see that share price increase, well, you know what? That's not fair, and so that's not allowed. So next we're on to learning objective 3, which we're going to catch in just a minute.